Hey guys, this video is about a strategy that is simple to use and has a very high win rate if used properly. All the trades which you saw at the start of this video were taken with the same strategy which I'm about to tell you. And I have personally tested this strategy for around a month from my live account, and here is the proof of that. Here is the statement of my live account and the trades I took. Out of all these trades, just exclude XRP trade as I was just testing how lot sizes work in cryptocurrencies. So I took 5 to 6 different trades on gold, silver, Ethereum and Bitcoin. And I had a total profit of $42,000, out of which $13,737 worth of profit is locked and the rest is floating. I'm going to break down each trade I took in the example section, but before that, let's jump to the strategy. So this strategy is going to need you to have knowledge about certain things like impulse and correction, highs and lows, Fibonacci, support, resistance, etc. So if you're not aware of it, I have added the link to all those videos in the description below. I recommend you to first watch those videos and then come back and watch this one. Now let's quickly jump to the strategy part. There are 4 steps to this strategy. The first step is to find the direction of the market. The second step is to find what the price is trying to do using impulse and correction. The third step is to draw the Fibonacci retracement, and the fourth step is to find extra confirmations for your entries. So let's start with the first thing. The first thing you have to do is to find the direction of the market. That is, if the price is moving up or the price is moving down. The reason why we are doing this is that we have to always remember that the trend is our friend and we should not try to go against it. So if the market is bullish or uptrending, then we have to keep a bullish bias and look for buying opportunities. And if the market is downtrending or bearish, then we have to look for sell trades. Now, to find the direction of the market, you can either use trend lines or mark normal highs and lows. Anyone would do. But here is a pro tip. Use trend lines for longer trends and highs and lows for shorter or smaller trends. Like over here in this example, the first thing which you have to do is to find the direction of the market. So in this case, we will first mark the higher highs and higher lows as the market is moving up. So in this case, this was the higher high, then a higher low, then a higher high, higher low, then finally high high, higher low, higher high and a higher low. So this is how first you have to find the direction of the market. Now you can also use trend lines in this case, but in this example it was better to use high highs and higher lows because there was no way to draw a trend line. After you are done finding the direction of the market, the next step is to look for impulse and correction. And for those who don't know what impulse and correction are, impulse is when the price moves in any one direction and strongly, and you mostly see single colored candles. And the correction is when the price moves sideways very slowly and we get to see mixed candles. The reason why we are looking for impulse and correction is that whenever the market is trending, the price first moves in a straight line, then it corrects, and then it again moves in a straight line. And the price follows the same pattern of impulse and correction whenever a market is trending. So we are going to use the impulse and correction theory to understand what the price is trying to do. Like when we learned about impulse and correction, I told you that in the trending market, whenever we see an impulse and a correction, the next impulse is most of the time in the direction of the first impulse. Now what I meant by using impulse and correction is that if you will see, most of the times after an impulse there has to be a correction. Like over here, this was an impulse, correction, then an impulse in the direction of the first impulse. So this is how the price is moving continuously. So what you have to do is find impulse and then a correction and see what the price is trying to do. So in this case, you can see here the price moved impulsively and then now price is giving a longer correction. So this is our first step, that after finding the direction of the market, we have to find what the market is trying to do. Like in this case, the market is correcting. Now there is a possibility that the price can give the next impulse in the upward direction. The only thing is we need to find when the correction is going to end. And that's when we are going to use the step 3. Now, if somehow we are able to find when a correction is going to end and when a new impulse will begin, we can easily find good entries and capitalize on them. And this can be done by using Fibonacci retracement. A Fibonacci retracement is an amazing tool that is very useful while finding an end of retracement or the end of correction. So the third step is using Fibonacci to find the end of correction. After you found an impulse and if the price is then correcting, all you have to do is draw a Fibonacci retracement. For that, just connect the swing highs to swing lows in a downtrending market and swing lows to swing highs in an uptrending market. Also, we are going to use only 3 Fibonacci ratios, that is 0.382, 0.5 and 0.618. So if you have any more ratios, you can delete it, as it may bring unnecessary emotions, like it could cause fear of missing out and also cause other problems while placing stop loss. Now the third step is to draw the Fibonacci retracement, and I have told you how to draw it in the Fibonacci video. So if you haven't seen that, I have added the link to the description below, so you can check it out. Now to draw a Fibonacci, what you have to do is select the Fibonacci tool and connect the lower high, like in the uptrending market, connect the lower high to the higher high, which will be around this level. So what Fibonacci does is it tells us when the correction is going to end. So when the price dropped till this level, which is around 0.5, it gave us an indication that the price can now continue to move up, like the retracement or the correction is over and the price can now continue to move up. So this was our third step, but we cannot rely only on Fibonacci levels. Therefore, we need the fourth step. Now the next step is to find the extra confirmations, like a candlestick pattern or support and resistance levels. We have to find some extra confirmations to get into a trade, as we cannot simply rely on Fibonacci retracement alone. So we have to try to spot if the price is giving any signs that the correction is about to end. And I have already added a video on support and resistance on that, and I also have a PDF of candlestick patterns for you all. For that, I have added a link in my description. You can go to the link and download that PDF from there itself. Now let's take some examples about what I mean. So the fourth step is to find any other confirmations. Like in this case, if you can see, we had a resistance level at the same 0.5 Fibonacci level, which provided us with an extra confirmation. So it was resistance previously, but when the price moved up, it is now acting as a support. So when we drew a Fibonacci from this level to the high, and when we got 0.5 level at the support, we got an extra confirmation that buyers can enter and the price can now move up. Now there can also be other confirmations like a candlestick pattern or something like that. Like in this case, you can see we got a candlestick pattern, which is bullish engulfing pattern at a nice support area. So if you want a safe entry, what you can do is you can enter after this candle, that is engulfing candle is formed over here. So you can use support and resistance, even trend lines or other confirmation tools. So these were the 4 steps that you need to follow for using this strategy. Now let us go to the chart, and as I promised, I will break down each trade I took with this strategy in front of you, and it would be like you are sitting next to me and watching me place trades. Okay, so the first trade which I took was of BTC US dollars. So actually I bought 2 Bitcoin at the price of 16971, but I cut the first one with a profit of around $2,500 and the other one is still running with a profit of around 6,412. Let me show you how I took this trade. First, I found out the direction of the market. Like in this case, the direction of the market was moving up and it was creating higher highs, higher lows, higher high, higher low, then again higher high and higher low. So this was the area where I took the trade, and this is the price level where I took the trade. So what I did is, first I marked the higher highs and higher lows. After that, I tried to search for impulse and correction. So here there was a huge correction, but then the price dropped with an impulse, and then here the price started to correct. So what I did is, I took the Fibonacci tool and then I connected the previous lower high to the new higher high. Then after this, I waited for the price to correct over here, and then at this point when the price finally showed rejection on 15 minutes chart. So actually I went back to the 15-minute chart and then I saw a rejection at this point. So I entered over here, and then my first take profit was at this level, which was around 2000, and let me show you, which was around 2,315 or $2,500. Then after that, I kept the other one running, which is still running now with a profit of around $6,412. The next trade was of gold. So I bought gold at around 1770.53, and the trade is in a profit of around 12,036. So let me show you how I took this trade. Again, the gold was in an uptrending market. So the first step is obviously to draw higher highs and higher lows, higher high, higher low, then a higher high and a higher low. The next step is to find impulse and correction. In this case, this was an impulse because there are single colored candles, then we are seeing mixed colored candles, and the price is also moving sideways. So this was a correction. So what we will do is, after that, I use the Fibonacci tool. Let me show you, like I use the Fibonacci tool from here, and then I connected this swing low to the swing high. Then at this point, we already had a resistance which the price first reacted to, then it moved above it, and so now it will act as a support. We cannot simply rely on Fibonacci levels. We need some extra confirmation. So in this case, I used support and resistance for an extra confirmation. So when the price dropped till 0.5 level, I entered at 1770.20, something like that. So which was somewhere near here. Now I took half of my profit at this level because this was sort of a resistance, support at first, but I thought it would act as a resistance for now. So I took half of the profit at this level, and then I kept the other trade running, which is now in a profit of around $12,000. The next trade was of Ethereum, and I bought around 10 Ethereum at the price of 609.82. I had a loss of around $120 in this trade. And after that, I took a trade of silver. I bought silver with a lot size of 1, but I closed half of the profit at some level and I kept the other one running. So I have a floating profit of around 9,470 on gold. So let me show you how I took this trade. So the price at which I bought gold was 22.011. So let's move to the chart. Okay, so this is silver and I entered around, let me see, 22.011. Okay, so I entered around here. So the price of silver was again in an uptrend. It was moving up from 24th March, and then I first marked the higher highs and higher lows, high high, higher low, then higher high and a higher low. So after this, I then searched for impulse and correction. So this was an impulse, and after that the price was correcting. Like this as a whole is a correction, and then there are small impulse, correction, small impulse, and then small correction. So the next thing which I did was I connected the swing low to the swing high. So in this case, let us say this was the higher high, higher low, higher high, then higher low, then a higher high. So we will connect this higher low to the higher high. So after that you can see impulse, correction, then the price came near this level which was around our entry point, that is 22.011, and I entered over here, and then the price started to move up. I took the first take profit around this level, as I thought the price can again come back till this level, and I kept the other trade running, which is now at a profit of around 9,470. Okay, so the next trade which I took was of gold. I entered a buy trade with a lot size of 1.11 and at the price of 1866.58, and in this trade I am having a floating profit of around 1375.29. So let me show you how I took this trade. So I took this trade around this level. The first thing was obviously to find the direction of the market, which was up, as we already have a trade over here as the price moved above from the support level. Now the price was again creating higher high, higher low, then a higher high. Now after the price created this higher high, first what I did is I took the Fibonacci tool and drew it. Then you can see the price came till this level, which was 0.5 level, exactly where I took the trade, and that was also the previous resistance from where the price dropped twice, and then now it is acting as a support. So I thought that it would act as a support and it would be a nice entry. So I entered over here. I kept the stop loss few pips below this, which is 0.618, and my take profit around this level. Okay, so the take profit and stop loss with this strategy will be whenever you enter a trade. Let us say if you are entering at 0.38 level, even then your stop loss will be below 0.618 level. Now even if you keep your stop loss at around 0.618 level, still you will have a risk to reward ratio of around 1:2. Like in this case, let us say I kept the stop loss few pips below 0.618 level, which is, let's say, 1.2%. So I again had a profit of 1.73, which is around 1:1.5. The risk to reward of 1:1.5. Now many a times what will happen is when you take such trades, you can go to a lower time frame like 15 minutes or 30 minutes time frame. Like if you are trading on daily time frame, then I will recommend you to move to 4-hour or 1-hour time frame to place trades, and then you can set take profit accordingly. Many times you will see that the trade opportunity is on the daily chart. So in such cases what you can do is you can move to 4-hour chart or 1-hour chart, and then look for any rejection candles or something like that. Like you will not always get support and resistance. So what you can do is you can find any candlestick patterns, and then you can set stop loss accordingly. Like let us say in this case, if I would have found a trade at around this level, and let us say this is 0.5 level. In this case, what I will do is, if there is a pin bar, I will keep the stop loss few pips below the wick of the pin bar till that candlestick pattern gets invalidated. So by doing this, what you can do is you can increase your risk to reward ratio. Now the take profit with this strategy will always be like, if you enter at 0.618 level, the take profit will always be around this level. Now if you are trading on higher time frames, then you will have to adjust the take profit, as the price will not quickly move to the 0 level, because it will take some time, and there may be, and it may happen that before moving up, the price can test that level several times, and then it can take your stop loss. So it is better to keep two take profits. Like I did in my trade, I kept first take profit over here and then I kept the other one running at break even. So you can do like that, but basically your take profit will always be at this level, no matter where you enter the trade, whether you enter at this level, which is 0.32 or 0.5 or 0.618. No matter where you take the trade, your take profit will always be at this level and your stop loss will be below 0.618 level. And if in such some cases, if you find a candlestick pattern at 0.382 level, there is a support over here, then you can keep the stop loss few pips below the support. And if there is a candlestick pattern, you can keep the stop loss few pips below that candlestick pattern, so that it can give you high risk to reward ratio. So this is how you have to use this strategy. It is very simple and easy to use, and you also get a decent number of trades with it and a minimum of 1:2 risk to reward ratio on each trade. So all the best with the strategy, and keep in mind that it is not only about the strategy but also the risk management plan, the trade management plan, and how you manage those emotions. So risk no more than 1 to 3% on each trade. Stay patient, keep the greed away, let the trade come to you and crush the market. Thank you so much for watching this video. I hope you enjoyed this video, and if you did, make sure you like and subscribe to help me grow our little Forex family.